Hello and welcome to Banking Transformed, the top podcast in retail banking. I'm your host, Jim Marous, founder and CEO of the Digital Banking Report and co-publisher of the Financial Brand. Competition in banking has greatly decreased in the past 20 years, with banking and technology giants using proprietary technology and data to tilt the playing field. Despite many new players in our industry, these firms don't always reach the scale that is needed to compete effectively and potentially changing the economic inequality, social responsiveness, and even the speed of innovation that is needed. My guest in the Banking Transformed podcast is James Bessen, lecturer at Boston University School of Law and best-selling author of the new book, The New Goliaths. Jim shares his perspective on innovation and competitive balance that can be restored not by breaking up large corporations, but by compelling these firms to democratize their data and technology for others in the industry. So welcome to the show today, Jim. Information technology has transformed our economy and brought innovations to the marketplace faster than ever before. The question is whether these technologies, data, and insights have become the domain of only the biggest organizations, stifling competition, innovation, the potential for equality, and even social responsibility. So, Jim, I reached to you after reading an article that was written by MIT Technology Review about your research, and then I read your book. And it really is interesting. The book, The New Goliaths, How Corporations Use Software to Dominate Industries, Kill Innovation, and Undermine Regulation. You can certainly say that's a bit of a controversial title, but can you share the foundation of your findings?
This summarizes maybe 5 years of research, so by myself and by many other people. It's become very clear that in the last 10 or 20 years, there's a whole new generation of proprietary software platforms being built by large firms. And I'm not just talking big tech here. We're talking big banks, we're talking big auto companies, we're talking Walmart, we're talking, but also Amazon and Google. Digital technology has been, the PC is 50 years, 40 years old now.
Wow. The iPhone, 15 years this week.
Yeah, pretty amazing. So in the early days, it was a very heady, positive thing that the low-cost computing was opening up all sorts of possibilities to all sorts of people, big and small. In fact, some of the small firms really benefited the most from some of the early innovations. But these large systems are a new and different beast, and it's huge. It's you look at firms spending on own developed software. It's well over $200 billion a year now. Big investment. And many of the effects of this are positive, but there are some downsides as well. So that's sort of what the book explores. I started by noticing that, or exploring the question of whether a number of economists had noticed that industries were becoming more dominant in their firms becoming more dominant in their industry. The top firms, their market share, the market share of the top four firms has increased overall over the last 30 to 50 years. But wasn't sure what that meant, but I wondered whether it had anything to do with these large software systems. And the initial research said, yeah, there's something going on here. The firms that invest, the industries where they're making these investments are exactly the ones where the industry concentration, as we call it, has risen. So I started to tease apart, what's going on, what what is this? And so one thing we connected was, well, the firms have also become more persistent. That in the 90s and 80s, firms were disrupted. There would be some new upstart comes along, and Walmart came along and disrupted Sears, uh, you know, and that's really reversed over the last 20 years. The probability of disruption has gone way down. So again, another puzzle. Uh, but when I started to connect the dots, what I was seeing was sort of a commonality that what these large systems do is enable big firms to manage complexity, to handle greater variety, to handle more product features, to more finely target products to customers and to advertise and reach those customers. So Walmart stores stock over 100,000 items. If you want to have a big advantage in retail, one-stop shopping is one way to do that. And by stocking all those items and tracking them well, they're able to streamline their logistics so that they can get the goods to the stores, A, quickly, and B, at a lower cost, so they can charge lower prices and they can respond more rapidly as they detect demand changes. And they've developed this whole system so that decisions tend to be made not so much by centralized merchandise buyers, but also by store managers and in many cases, suppliers. So it becomes this very flexible. It's not just the technology, but the technology is the core of this whole new system of taking advantage of greater variety and flexibility to deliver what customers want. And you see similar ways of managing complexity in banking, in manufactured goods like automobiles, which are now largely software driven, as well as the standard target marketing of Google and Facebook. So maybe I should pause here and let you get a word in.
Well, no, it's interesting because you mentioned the banking industry. As in many industries, we have seen new firms enter the marketplace at an unprecedented pace. These firms are addressing the unmet needs in the marketplace, usually leveraging digital technologies that are not yet being leveraged by legacy firms. But are you saying that the majority of these firms, these startups, these innovators and such, that they'll ultimately fail either because they won't reach scale or that they'll actually be acquired by these same big firms that you're speaking of?
This is one of the downsides of these new systems. The systems have allowed big firms to dominate their industries. They're bringing they're doing this because they're bringing great benefits to consumers. But at the same time, one of the critical things is they make it much harder for an innovative startup firm to grow. So here's a key aspect of what. Let me just back up a second. A key aspect of what drives productivity growth in the economy, it's not just that some firms improve their own productivity. It's actually more so that the more productive firms grow faster. And eventually they may replace the large incumbent firms. One of the most disturbing findings is that over the last 20 years, this growth rate of highly productive firms has slowed. And that, in fact, accounts for much of the slowdown in productivity growth that we've seen in the aggregate economy. Now, I don't know about banking specifically, but what we see in the numbers generally for technology-based firms and for all firms is that the rate of entry hasn't slowed. We still get new firms coming in with new ideas, and often they're more productive. But what we do see is productive firms are growing much slower, maybe half the rate as firms that were equally productive 20 years ago.
Well, it's interesting because in the banking industry, we see the biggest banks getting bigger. We also see them actually growing at a pace that is certainly slower than what they used to be able to do. But still, they have the scale that allows them to perform at a rate that is unachievable by many of the smaller fintechs. Now, we have the big tech firms that are also playing in banking. But really what you're talking about, and I think you referenced in your book as the superstar economy and the movement from open to closed capitalism. What you're saying is that the big firms are actually slowing the rate of innovation, slowing the rate of growth, and slowing the rate of actually transforming an industry because they're so big, correct?
Yeah. So they may be growing fast and they may be innovating. And in fact, the evidence shows that the larger firms are becoming more innovative at a faster rate than medium or smaller firms. In fact, there's a growing gap between the biggest firm, in terms of, just look at revenues per employee. There's a growing gap between what the top firms, largest firms make in revenue per employee and everybody else. And that's troubling. What that says in a way is that those firms are able to access technology that the rest of the market can't access. And if you look at what's involved in these large systems, that's very much the case. So that the big firms have access to data, to software systems, to organizations that can take advantage of this new sort of technology that the little guys can't, for the most part. Even though you've got some great companies come along with important innovations, and sometimes, they get bought out. But what we're seeing is they're growing more slowly. It takes longer for a startup to raise funds. Once it raises funds, it takes longer for it to be acquired or to go public. It's all stretched out, and that slow growth hurts the economy.
Well, even name recognition. You have a lot of small companies that have done well. But if you go in the marketplace and ask people, do you know what Acorns is? Many people don't know that Acorns is an investment and savings platform in the banking industry. Many people may not know what Chime is, but they know what Chase is. They know what Wells Fargo is. They know what Bank of America is. So that's even there. One of the biggest challenges that companies are facing today is reaching the efficiency possible with just like digital technologies. It's possible to do it. But the problem is those mid-sized firms that you're talking about, it costs a lot of money. So while firms can become more efficient, they still have legacy systems and delivery networks they have to deal with. Is there another case where the biggest firms have an advantage being able to spread these costs over a bigger platform and the ability to automate the back office faster as well?
You're saying, is there a case?
Yeah, I mean, is that what you're seeing as well? That it's automation speeds up and the ability to take advantage of scale becomes really the domain of the biggest firms.
Yeah, well, it's scale and it's scope. They're able, my argument is really about scope. They're able to offer more products and, address more different consumers. And that's exactly part of the story.
It's interesting too, because while Chase is still building physical facilities, they still are able to spread those costs across a much greater platform. Right. And one other thing you bring up in your book, and it's interesting, is we've talked about it in the past in banking, but it's something we forget about often. And when we're talking about the cost of delivery, that the cost of compliance is pretty much a fixed cost for almost any organization. It's the same amount of money to manage the compliance issues of Amazon as it is the small retailer. I would assume that because the fact that it's a fixed cost, this obviously falls the heaviest again on the smaller players, the mid-sized organizations. Yep. And that makes it so that just the efficiency ratio, just the effectiveness of being able to hit the types of, back office automation and scale that's needed, it again puts those smaller innovative firms and those mid-sized organizations at a tremendous disadvantage. Now, I'm going to ask you a question here about those mid-size. Do you see a way where mid-sized organizations can combine and possibly, play the same level playing field as the big guys, or is the field just going away from them, where the big are just getting so big that you can't acquire enough mid-sized organizations to bring the scale that the big guys have?
Yeah, I think that's one possibility. In the book, I talk about another one, which is the notion that the biggest firms may open up. So we've seen examples of this in the past and also currently. So what I call it unbundling, or it's been called unbundling in the case of IBM. So there was this famous case where, IBM used to sell the computers and the software together. And it became very difficult both for other computer vendors, because IBM was bigger, it had more software written for it, and it became very difficult for, there was really no independent software industry, because, you could write it for IBM, but it wouldn't run on the CDC computer or whatever,
Yeah.
Honeywell computer. Well, under threat of the Justice Department over an antitrust concern, in 1969, IBM unbundled it. It allowed you to buy the hardware without the software, and they sold the software separately. And that essentially created the modern independent software industry. And that was a huge, huge boost. And while you think that might have hurt IBM, it actually turned out to be hugely profitable for IBM. They now had more competitors in software, but every competitor in software improved the value of the hardware they were selling, and the size of the entire market just exploded. A modern day example of that, several examples of that come from Amazon. So Amazon developed this tremendous in-house IT capability. They had to handle their website, handle
Right.
transactions rapidly, large numbers of transactions. So, and they realized around 2004 that this gave them a real competitive advantage. Well, most companies, I think, would probably say competitive advantage, let's hold on to it as tight as we can. They took another idea. They said, let's open it up. Let's standardize it so there's a standard API, and let anybody come and use our IT facilities for a fee, of course. But they created the cloud industry. And that too has been hugely profitable for them, but also hugely productive, because the tiniest company in the world can gain access to very sophisticated data storage, data handling, IT processing, AI, you name it. There's just a tremendous ability to, so that Amazon has the scale, but they make it available for a fee to everybody
Yep.
else, so the middle and big size players can get involved in the app. Now they do a similar thing with their logistics and their marketplace.
Yep.
I won't say that there aren't some concerns and issues, antitrust possibilities. Amazon has to walk a narrow line between being a competitor and a supplier.
Yep.
But I think that's been a hugely beneficial thing. And what I would like to see, and I think what may solve some of these problems, is to spread that more broadly. Now, one of the big things in the U.S. in banking, I understand. Now, you guys understand more about this than I do, I think, is access to customer data. That
Yeah.
the fintech companies have just been struggling. They're getting more of it, but there's no standard API. Not every fintech can get what it needs,
Right.
and it's burdensome. There's no reason the bank should be they obviously feel they have a proprietary advantage from all that data, and they do. They do tremendous things with it. They can make different credit offerings to different consumers for home equity or for credit cards, and target them, and God knows what they do with it. But if customers can get their own data and make it easily portable to another platform, they can do many more things that they can't get from the large banks. And I think that may be the frontier of where things need to open up in banking.
So let's take a short break here, and I'm going to get back to that whole issue of the democratization of data, expanding what Amazon done with the democratization of technology and innovation, because I think there's a lot there. So let's take a short break here and recognize the sponsors of this podcast. This show is sponsored by FIS. From super apps and crypto to embedded finance and financial inclusion, we're a long way from the world of cash and checks. That's why FIS has published the Global Payments Report. The Global Payments Report makes it easy to understand what your customers want now and in the future. Read about the trends transforming payments and what they mean for your business. FIS also gives you an in-depth view of how consumers pay when shopping online and at the point of sale in more than 40 markets, along with the latest insights into real-time payment trends, digital wallets, and even crypto. Discover how the latest payments technologies can affect your business. Get your report today at fisglobal.com/GPR. FIS, advancing the way the world pays, banks, and invests. Welcome back to Banking Transformed. So, I'm joined today by James Bessen, lecturer at Boston University School of Law and author of the book, The New Goliaths. You have been discussing the potential impact on competition, innovation, and social norms as the biggest organization in every industry are using technology and data to create an imbalance in the marketplace. So before the break, Jim, we were discussing how there's an ability to buy modern technologies and automate businesses, and there may even be a potential to democratize that process. But really, at the core of everything is the data and insights that these firms hold. I mean, a Chase, for instance, has so much data on their customer base that a smaller mid-sized firm would never have, certainly not a fintech. Does this magnify the advantage of the big firms? And is there a potential, as you mentioned before the break, to maybe democratize the data and insights, maybe by a firm such as Google that has so much insights, or even Apple, or an Amazon, to make it so everybody's on a little bit more of a playing field, certainly at a cost, they make money on it, but to make it so that there's a little bit of a level playing field with regard to what you know about me, the consumer.
Yeah, absolutely. I mean, I think that's what I was talking about in the Amazon example. I would stress, people do talk a lot about data. It's not just the data, and it's not even just the technology. So, you know, in the late 1980s, Sears was, you know, the lead retailer. It was also a technology pioneer. Sears pioneered e-commerce. They had the Prodigy Network. Sears was IBM's largest customer. And Sears certainly had a ton of data. What Walmart was able to do, though, was use the data and marry it to a different sort of organization. So it wasn't just the software. It wasn't just the data. It was the whole thing married with, a different way of organizing and conducting business activity. But you're right. The potential is there for firms to essentially, they have these internal platforms, and it's about opening up the platforms. That's what Amazon did when it took its internal IT platforms and made them into the AWS, Amazon Web Services.
Yeah, it's interesting because when you look at data, we also often look at just do I hold it in my file, not hold in my file? But, when you look at payments now is more dominated by the PayPals, the Amazons, where people are buying. And that data is kept internal. So what happens is financial institutions, when they used to have it on their credit card, would get the individual transactions and know where people were buying things, what they were buying, their preferences. Well, now it just shows up as Amazon. They don't see the individual detail. So it really becomes even a bigger challenge. One thing you really bring up in the book quite a bit is that this imbalance, this ownership of technology and insight and data and overall automation impacts the consumer, both economically and from a social responsibility perspective. We sometimes lose that. Can you explain a little bit about how this really does impact the consumer?
Yeah, that certainly affects the consumer. So, one of the things is this technology allows consumers to get much greater choice. Choice is, to some extent, a double-edged sword. It means it becomes burdensome in some ways to, when you have 100,000 items in the store, you go online and there's this, what was it? I saw in the Wall Street Journal, 180 different garlic presses on Amazon. Some of those were fake. Apparently the Chinese have figured out some way of gaming Amazon a little bit. But still, there's a lot of choice. There's a lot of lack of information about the quality of products. So it provides some real benefits. I can buy things today that I didn't even know existed before in the old retail environment. So there are some great benefits. There are some social impacts, though, that may be less obvious. So one is on wages. It turns out, there's this talent war people talk about, and it turns out that the large firms with these large systems not only hire more talented people, they pay them more. They'll pay more for, a job that has the same characteristics. And I'm talking substantially more, 15, 20, 30% more.
Wow.
So it may make it more difficult for small companies to hire who they need. B, it leads to growing inequality, that, you have these people who work at the elite firms and you got everybody else, and we're seeing growing gaps. And those, by the way, are also geographical gaps because of where the big companies hire. Tends to be large cities, coastal. That's one thing. Another
Right.
implication is these systems it becomes much more difficult for government to do its job in terms of regulating systems when products are based on software and services are based on software. So one of the prime examples is the Volkswagen diesel emissions scandal, where a few lines of code and of the hundreds of thousands of lines of software code in a modern automobile, somebody, they got a few engineers to tweak the code so they could fake out an emissions test, and the car would operate at low levels of emissions when it was being tested, and the computers would tell, by the angle of the wheels, the speed, how long it's been driving, and when they detected they were no longer in an emissions test, they would boost up the nitrogen oxide emissions 20-fold, so the car had a lot more performance all of a sudden, but was polluting, 20 times as much. And this went on for years, and the government regulators, both in here and across the world, had no clue what was going on.
So given the somewhat dismal painting of a picture you've done around the competition, the innovation, the social norms created by the centralization of technology, data, and innovation and power, you still don't believe, at least in your book and in what I've written or read, that you believe these firms should be broken up by the government. You referenced already possibly better solutions than that. What are the threats maybe of the government doing what they tend to do, which is like bull in the china shop, just doing what comes easy, which is, saying, oh, we got to break up Amazon. We got to break up Google. We got to break up Chase or Bank of America.
Well, there's certainly people in Congress and in the administration too who might take that view. That may happen. It's not going to solve the problem. I think that's the first, the first answer. Breaking up a company doesn't solve the problem. Somebody's going to still be there and able to build a large system that can dominate. But the other thing is, these systems are real benefits to society. It's a real benefit to society for Amazon to have its enormous web services division, right?
Yeah.
It's a question of how whether that benefit is being tied to proprietary control or whether it's open in a way. So my solution is this thing I've been talking about, that there are a number of ways that the government can nudge companies to open up. In many cases, it's going to be in the company's own interest. There's no doubt that when Amazon opened up web services, it turned out to be hugely profitable to them. Maybe even more beneficial to its customers, but still, there was good private reason to do that. There are various government powers that can encourage that. One is intellectual property controls, things like employee non-compete agreements, which are being now used more and more aggressively to keep talented, knowledgeable talent at one company from going to another. We need to spread the technology and spread the knowledge more aggressively, and that's really what's at the root of most of the social problems. So it doesn't take a sledgehammer to shatter things to solve that problem. It takes, some well-crafted, and in some cases, may perhaps punitive measures to encourage, or in some cases, to force firms to share their data, to open their technology in a way.
That's interesting because as you were speaking about this, I didn't realize, or I didn't put together possibly, even though I've read your book, the fact that while you can split up companies, physical assets, you can't all of a sudden say, okay, we gotta split up your technology, we gotta split up what your systems say. That's impossible to do. So I think you're right that splitting up may not get the solutions that they want. It may make the companies smaller, but that doesn't make them any less smart. Doesn't make their data any less valuable, or it's not a way to do that. And it really gets down to, and we've seen some providers actually democratize what they offer to the marketplace and make a good future. That I think we're looking at maybe new revenue opportunities as well as new ways to compete. So how do you see the future actually moving in this direction? I mean, as you look, nobody wants to take the risk of the crystal ball anymore because we know what that gets you.
Yeah, well, I'd like to think it moves in that direction.
Right.
I think it's encouraging that we see companies like Amazon doing it themselves, and there are others. There's certainly others.
Yeah.
There's people at Harvard Business School and at the Questrom Business School at BU, Boston University, that are sort of advocating this as a good business strategy for firms.
Yeah.
I think in the policy arena, a lot of the policy has been moving in the wrong direction. They're giving firms greater controls over employees' knowledge. That's disappointing.
Right.
But will it happen? I'm not going to hazard a guess. I'd like to see it happen. It's certainly conceivable it could happen.
The government tends to not always make the best. They make quick and not good. We've seen this too much recently, and I think you're right to try to predict what, because this can become a governmental thing in one way or the other. It's not going to be driven by the consumer as much as by the government, and I think you have all bets are off when that takes place. So Jim, how do listeners buy your book?
It's available at Amazon or at Yale or other common outlets.
Yep. And this is what it looks like. It's a great book. I suggest my listeners, I should say, get this book. It was interesting because it was taking a different perspective than we hear in our industry quite a bit. Jim really digs into a number of industries. It's not focused on banking. You really have to open your mind to how this impacts the banking industry. But Jim, thank you so much for being on the podcast today. I really appreciate your time.
Thanks for having me.
Thanks for listening to Bank and Transform, the winner of 3 international awards for podcast excellence. If you enjoyed today's show, please take some time to give our show a 5-star rating. Also, be sure to catch my research on the Digital Banking Report and the articles I'm writing on the financial brand. This has been a production of Evergreen Podcast. A special thank you to our producer, Leah Haslage, audio engineer, Sean Roll-Hoffman, and video producer, Will Pritz. I'm your host, Jim Marous. Until next time, remember, concentration of power in any industry is not the preferred outcome for the consumers or business itself. Democratization is the answer.